Our conversation of the day now on the equity markets, the stock market, with Michael Wilson. Mike Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley. Mike, you go over and you study Ellen Zentner's notes and you look at fiscal tightening. Describe fiscal tightening. Describe what it means for the Standard & Poor's 500.
Yeah, good morning, guys. Look, I think, I don't think we've hit a wall completely here, but I think it's fair to say that the fiscal impulse that we've experienced over the last 12 months caught a lot of people off guard, including ourselves, and it has really kept the economy going in a way that most people were not projecting. And that has led people to believe that this can continue. Now, there's been a confluence of events for why interest rates have risen. I wouldn't blame it all on the downgrade last week. In fact, probably none of it is. I think the bigger issue is just simple supply and demand. We have an enormous amount of supply to fund all this spending at a time when perhaps some of the natural buyers are not there anymore. For example, the banking system, pretty full up on treasuries. And, of course, the Bank of Japan's changed last week. So, I think the interest rate move, look, first of all, stocks were already expensive on their own cost of capital going up. Now, think about it this way. The recovery we've had since COVID has been funded by the government for the most part, okay? And now their cost of capital is going up. So that has to have some sort of a knock-on effect to valuations. If we were trading at a lower valuation here, I wouldn't be so concerned about the growth outlook. But given our growth outlook, which is more pessimistic than most, that's where you have a real issue. And look, you can still make money picking stocks. It's just a harder game. And I think that's what most clients are having trouble with.
That's where I wanted to go, Mike Wilson. I think this is so important. If we get a fiscal tightening and whatever your matrix is of equity dynamics folded into economics, if you will, does it lead to a more aggregate summed index? Or is it where sectors and selected stocks, including the glorious 8 tech stocks, they're partitioned out, they do great while everybody else struggles?
Well, that's been the bet that has worked so far this year. But now even those stocks seem to be tiring. I mean, this earnings season has been a sell the news, so to speak, if you want to call it that, even with companies that put up good numbers, it's been kind of a faded because the market anticipated, kind of this stronger economic bounce this year and perhaps earnings not being as bad as people were thinking, and then we kind of muddle through. So now the question, I think for this rally to continue, it has to happen internally, right? We have to have breadth improve. We need to see a rotation into some of these lagging areas. We've started to see that. We're not convinced yet. That the breadth, the way we measure breadth, is not convincing to us yet, but we're open-minded to it. But that would be the next stage of the bull market. If you want to be bullish, you have to be buying laggards here. You can't just keep chasing the Magnificent Seven and forget about everything else. That's not a healthy outcome.
What about what Cameron Dawson was talking about, especially at a time of rising yields, in part due to the fiscal backdrop, the supply and demand that you're talking about? It turns out that stocks become not a TINA trade, but a little bit there is another alternative that's much better. The revenues are going up in an inflationary environment. Yes, multiples look high, but what are you going to do? Go into bonds that are losing value at this point? I mean, how much do you buy that type of argument?
Well, we don't buy it because our view is that inflation is coming down much more rapidly from, at the company level than it is in the government statistics. And this is where I think it could get really interesting or tricky in the second half of the year, which is we have government statistics reporting inflation still at 3 to 4%. So the Fed is, going to continue to hold or maybe even raise more. Yet what companies are actually seeing in their businesses, Lisa, are deterioration. Like we have negative price now in many of the good sectors, right? The PPI, finished goods, is in negative territory, export pricing, import pricing. So it's the opposite of 2021. Think of it this way. In the back half of 2021, companies were getting 15, 20% price, yet the Fed was on hold because they were saying, well, we're not sure yet this is going to be permanent. Of course, they were late to the party, and companies got to over-earn at a very low interest rate. Now you have the exact opposite. Interest rates are being held very, very high at a time when company earnings for the majority, not all, but the majority of companies is deteriorating, meaning sales growth is not increasing. It's actually going down, and we have 0% sales growth in the second quarter. And if we're right on this pricing dynamic, then that's going to be something that catches folks off guard. That's why we're not going into small caps and the lower quality parts of the market. If you're going to go to the laggers, make sure you go to laggers that have good balance sheets and good margin structures. Okay, so it's still a quality play, just different quality names.
if inflation is going to come down and come down rapidly, then why wouldn't that really favor a Fed rate cut that could turbocharge some of the trade into big tech?
Well, because the Fed they know they made a mistake, and they've said it, right? They know they were a little bit late on the transitory call. Okay, fine. Why would they cut rates if we have full employment? There's no reason to do that. Unemployment is 3.5%. You have inflation still north of 3%, so not anywhere near their goal. Just hold. I'm not making the case they need to raise rates here. I don't think they need to do that. But I think they're going to want to see the whites of the eyes to make sure that things are down. I don't work at the Fed. I don't know what they're going to do. But my prudence would say that's what they should do. They should pause and see what happens and not try to anticipate too much here, because that got them in trouble last time.
Mike, can we just finish with your framework, post-pandemic framework? We'll remember it well. It was hot and short. The cycle would be hot, but ultimately it would be shorter than what we'd seen previously. Now, Mike, it certainly was hot, and you got the equity market call coming out of the pandemic dead on. But, Mike, does anything lead you to question the short part? Because I think that's where the conversation is quickly shifting, as you know, over the last couple of weeks.
Yeah, this is going to sound ironic. Okay, so as you remember back in January, I was concerned that everybody was too bearish, including ourselves, and that proved to be the right, I should have gone with my instinct. And now, though, I think the fact that everybody is saying that the recession risk is eliminated for the most part, including the Fed itself, right? They had called for recession back in March, at least the staff did, and they backed off that too. I don't know if we need a full-blown recession, but I'm pretty convinced that growth is still slowing. We're in a down cycle. Now, whether that leads to a full-blown labor cycle or not remains to be seen. I think most people have pushed out the recession call to 24. I don't think they've said it's eliminated. So it may be a 4-year cycle as opposed to a 3-year cycle. That's very plausible. I really like our boom-bust short cycle thesis based on the 40s, because I see the data really supporting that, John. And part of our note over the weekend, and you can appreciate this because you've followed it the whole time, is that we kind of missed this fiscal impulse, right? That was a big miss on our part. We thought the fiscal impulse would come at the time that they really needed it. The thing about it this way, they're doing 8% budget deficit spending when you have 3.5% unemployment. That's really unprecedented. So what's going to happen if we do get a slowdown next year? And I just think this boom bust thesis is still correct, and maybe the market's looking through it to the other side. Look, that's a risky proposition given where valuations are. It was a great idea to buy stocks last fall. We traded it. We didn't stick with it long enough. Okay. But I think at this stage, you need to be very selective for some sort of retracement, at least back to the 200-day moving average.